Hey everyone, welcome back to the channel. I'm Doug, the retirement guy with the monthly ETFs. Today, we got a couple different questions. An investment strategy that actually works, growth in income from one ETF. Well, TappAlpha ETF review, they have two funds right now that just seem to be answering yes to both of these questions. And we're going to break them down and show you how they compare with other funds and give you the insight of what TappAlpha is actually tapped into. Well, before we do that, got to do a shout out to all of our Patreon and our YouTube members. Thank you so much for supporting the channel. Without you guys, we could not keep this videos going. And if you're all of our subscribers, if you're not a subscriber, don't be afraid to hit that subscribe button. Don't hit that bell notification button. You don't want to miss a single one of our videos. Let's get into today's video. So who is TappAlpha? They are a specialized ETF issuer focused on rule-based strategies that blend equity exposure with option income to create an innovative investment solution. Now, their rule-based approach is a systematic strategies that follow transparent rules rather than relying on market timing or active management. They have an equity plus options blend. It combines traditional equity exposure with option strategies to enhance income and manage the volatility of the funds. They use target profiles, designed ETFs for income-focused and volatility-managed portfolios with clear investment objectives. And then they also have the risk adjustment returns. The goal is to improve the risk adjustment returns through smart overlays that enhance yield and managing volatility. So when we look over the two funds that they have, TappAlpha offers two distinct ETFs that leverage option strategies to enhance that income. The first one, I call it the new fund, and that's going to be the TDAQ. This is the Nasdaq 100. It's the Nasdaq 100 exposure. It gives you an option overlay targeting additional premium income and is designed to reduce volatility while maintaining growth potential. Now, the old established fund, TSPY, this one goes after the S&P 500 exposure. It's an income-focused option overlay designed for stability in income and a broad market participation. So they both have similar strategies, but also using a little bit different of a twist to generate different outcomes. So let's break them down and show you exactly what I mean by that to give you what each fund can actually do. We'll start with TSPY. This is the deep dive into it. This is the one that's focused on the S&P 500, and its real goal is designed for income-focused option overlay. So they're trying to give you that potential stability in income in a broad market participation. So with its core base around the S&P 500 basket, the income generation that uses covered calls or similar income generating options to generate that potential consistent premium income for investors. And the volatility management, the volatility managed structure that aims to provide a smoother market experience compared to the direct S&P 500 exposure. Now, the strategic objectives is to generate that potential income while capturing upside of the broad markets, providing a balanced approach. They have $151 million under asset. Now, this fund has been going for just a hair over a year. It came out, I believe, in August of 2024. So $151 million under asset. Their year to date, now this is based on year to date numbers as of December 8th of 2025, that they have a 13.68% yield. Their growth of the fund is 1.79% year to date. Now you look at the chart below, you can see it had a massive drop off in April for that tariffs. It rebounded fairly well, and then it had a slight drop off in November, but rocketed right back out in December. So that gives them a total return of 15.47%. Now the TSPY, the strategies and strengths. You look at it, they are in that sector. They are buying the S&P 500 sector, so they're in the technologies. They got the consumer discretionary. This is not all of that they're into. It's just a really quick snapshot of it. It's a strong, diversified, broad 500 S&P 500 exposure across 500 large cap companies. That's why I said up top is only a snapshot of what they have. They have that steady income potential, which is the constant income generating through those covered call strategies. And it's a simpler than managed your own strategy. It's the professional implementation of an option strategy that they use. So the considerations on this one here is the only thing is you have to be a couple concerns is that's the capped growth upside potential. The upside growth is limited because of the covered call strategy. The volatility dependence. Income generation varies with market volatility, potentially leading to fluctuating dividend payments. So if we don't have the volatility, the payments are going to be, they're going to be less in the payments, or almost to the point of getting no payments because nothing is guaranteed in these funds. So the income supplement only, the best view as an income supplement to a core portfolio, not a replacement for a pure S&P 500 fund. So what they're basically saying here, it's really works for income, not for the growth side. It's designed for income. Where S&P 500, if you look at that, everything S&P 500 is for is about growth of a fund. It's not a pure index tracker. It does not it's not passive long-term S&P 500. It makes the adjustments in S&P 500. I would put it goes to the hot stocks. It goes to the hot fun things. It doesn't just cover the whole S&P 500. It's constantly changing those what sectors the strongest currently. Now let's take a deep dive into the new one, the TDAQ, the Nasdaq 100 exposure with the option overlay designed to reduce the volatility while maintaining its growth potential. They focus on the Nasdaq 100. They use that options overlay. They have that growth potential and main participation in that tech-heavy market. And their strategy is equity exposure to the Nasdaq 100. When we look at the numbers, this is since September 4th. This one came out September 4th of 2025. They already have $48 million under assets under management. Now their dividend is 2.81%. Now before you jump out and go crazy about this, remember this one is more on the growth side than dividend, and that dividend is only from September 4th. So when we take a look at the growth, you're at 7.79% since September 4th and a total return of 10.60%. So I keep saying since September 4th, but start doing the math to it. When you were looking at September 4th, we're really only looking about one quarter so far. We're just a hair, into our fourth month of this package. So at 4 months, getting a 7.79% growth and a 10.60% return talks volume. Now the volatility reduction, what they have done, you look at the blue line, which is their option overlay that they've tried to do. They're not timing the market. They're just kind of consistently doing what needs to be done that fits the current tradition or current style that's going on. And a traditional ETF that's always going in the marketplaces up and down, you look at the lines. So the volatility is a lot higher with a traditional ETF than it is with the TDAQ. And only in the middle did they actually combine the two. So when we look at the strategy behind this, again, it's the higher income potential, the traditional Nasdaq ETF and option premium income, the predictable cash flow, regular income streams from option strategies because they've eliminated that volatility. They've lowered their volatility. It gives you that strong potential. Growth and income blend, the idea for investors seeking both components, and with that lower volatility, it gives you more stable price action. So the considerations, things to look at is the upside cap, again, by the call writing, the NAV volatility, and not for long-term tracking. And what does not that mean? It's not intended as a pure long-term NASDAQ tracker. So this is not, again, this is like we talked last time. This is not a fund that you're going to buy and say, I'm in the Nasdaq 100. No, you're in the TDAQ fund that works with the Nasdaq, but doesn't track it to a T. That's what most, when you say someone's in the Nasdaq, they're tracking Nasdaq as a complete strategy and as a hold. Now you can see here the difference between the two, and it just shows you that cap upside potential, that a normal growth is going to have that extra growth. So we're going to take that little gap between those two and create income from that. So let's do a real quick comparison. What are these two? Where do I want to be? What do I want to do? And what we take a look at as the TDAQ, the design of TDAQ is to go into that NASDAQ 100, which is going to have a higher volatility. It's going to have a moderate upside. It's going to have a higher than TSPY's volatility. And it's best for growth and income blend investors. While TSPY, the S&P 500, has a more moderate income level, it's a lower on the growth side. It's lower on volatility, and it's designed for income-focused people. So let's do a comparison about some of the other big ones that have been out there. And the first one we're going to put up is going to be the TSPY, the S&P 500, up against SPYI from NEOS, which has really been known for, probably one of the newest and most, aggressive funds that's been out there for the S&P 500. Well, when we take a look at these two head to head, we look at the yields. You got 13.68% to 11.59%. So TappAlpha has a bonus, almost a full 2 percentage points above. When we look at the upside growth, we're looking at 1.79 to 4.05. So the growth is on the SPYI. And when we get down to it, total return, which is the thing I always tell you, always watch total returns. And you can see at total returns, they're both about equal with each other. There's only a 2.2% difference between these two funds. So, again, you ask yourself, which way would I want to go? Well, what is it you're looking for? You're just basically trading off 2 percentage points into growth versus income. The bottom lines are both the same. The other thing I look at, though, is look at the dollars and cents. At $25.52 at the time of this video, these numbers can all change. I got to note that right out there. All things can change as the stock market's up and running as I speak. These numbers are changing. But look at the difference between the two. $25.52 versus $52.86. So you can almost buy 2 shares to the price of 1. So what does that mean? Well, you can buy twice as many shares of TSPY versus SPYI, even though you're getting the same amount of money would be invested. If something happens, you have more shares to rebound or do things with. Now let's take a look at the the TDAQ versus QQQI, the other NEOS product. They're both the Nasdaq 100. Now, this is going to be a little bit fluctuation. I did it a little bit differently for you so I can explain. So when we take a look at Nasdaq, the QQQI Nasdaq, that is going to give you the year-to-date fund. So that thing's been January all the way up to here, almost December, almost a full year. And you can see there at 13.5%, 4.96% for growth for a total of 18.46. So that's what it's done so far. Now let's break this thing down into a smaller picture of apples for apples. So TDAQ started September 4th, so I came up with September 4th numbers on QQQI so we can compare apples for apples. When we look at 2.81% on the TDAQ, while the QQI is at 3.48. So realistically, we're about 3/4 percentage points different from each other. But look at the growth upside, 7.79% versus a 3.37%. Okay, so there's a big difference of almost over 4.5 percentage points difference. And when we get into total returns, we're talking 10.8 versus 6.85. So there's that 4 percentage point difference. So what does that really tell us? Well, if numbers all stayed the same and everything was right, and using the QQQI forecasting that it did, we would easily be probably in a 22.8, 22.9 percentage point for a 12-month period of TDAQ as it is in QQQI. So what it's telling me is that we have that potential for this thing to perform equal to, if not better than, what the NEOS products have been doing, which is a great thing because everyone knows NEOS is a very, very strong monthly paying ETFs. So this being so new, we have to make sure people understand and know about this. And again, we go back to the price structure. We look at the charts. Both of them had the drop off in November, so they placed with that. So it gives me an idea that, yeah, these two are going to run neck and neck. And you got a 26.77% or dollar price per share versus 55. Again, I can buy twice as many shares and hopefully be able to gain more on the growth side of it. So both funds look to be very strong. So it goes back to is who's the ideal investor. This is all about what fits your risk, your goals. Do your research. Tell us what works for you. Each ETF attracts a different type of investor based on their goals and their risk tolerances. The Nasdaq 100 TDAQ, that people want that tech exposure and appreciates the income but seeks growth and is comfortable with a little bit of volatility. When TSPY investors want stable income, they want the value for the U.S. market and prefers a little bit smoother of a ride. So overall, I got to give you the risk and my final thoughts of this. And the risk is downside risk. Neither ETF eliminates that downside risk. And both of them have that capped upside. Even though they both showed some decent growth, they both have capped upsides. You have to remember that. And income variability. The funds are not guaranteed. There's volatility out there, and that's going to change. It's not a weekly, you're going to get so much every week. You're going to have a change off of the market conditions. But both final thoughts of this, they're very strategic tools. They are both ETFs. The examples, the modern ETF intelligent option overlays. The portfolio construction uses a part of a diversified retirement or income planning structure, and it has a personalized approach. Both of these popped up on my radar as maybe these are the funds for 2026 to add into my personal portfolio. I'll do more research onto it, and if I do, I'll share more information with you guys. But I wanted to give you this information. Tell me what you think. Are these funds strong enough for your portfolio? Are these things to add to, or do you think they are just another repeat of what NEOS is already doing? So let me know what your opinions are and give us a comments down below. We'd love to hear from you.